We hear about stories like this because what is Good morning, everyone. I am Ashley Wheat, your new financial representative. I am so excited that you have begun your new financial journey in the world of investments. As new investors, of course, the world of facts and figures that is the stock market might seem overwhelming. However, with the proper knowledge and dispelling of a few myths, the world of investments can be less stressful and quite profitable. So, it is my duty and pleasure to introduce you to a few key features of investing in order to make your investment journey a lot more enjoyable. One of the major concepts of investment strategy is the belief in or denial of the efficient market hypothesis, or EMH. This hypothesis states that all relevant information is already reflected in stock prices. Therefore, all stock prices are fair. I know you're probably thinking, well, my friend Mike bought an underpriced stock and now he's living on beachfront property. Stories like that are what made many of us decide to throw our hats into the investment ring in the first place. While these remarkable returns or contrasting monumental failures do occur from time to time, they are hardly the norm. And rarely are investors able to beat the market. And here's why. Everybody's looking for that golden stock, that one unbelievably cheap stock that no one else knows about that's going to skyrocket and make you a fortune. That's why we're all here, right? Well, I hate to be the one to break it to you, but it's not going to happen. And the reason it's not going to happen is because of what I just said. Everybody's looking for it. Firms hire overpaid technical analysts to track past stock patterns or fundamental analysts to examine firms' current and expected financial status in order to determine whether or not a stock is under or overpriced. With so much competition, it is virtually impossible to discover game-changing information that no one else knows about. In order to better understand the efficient market hypothesis, let me point out some basic features. There are three variations of EMH: weak form, semi-strong form, and strong form. These three forms differ in their definition of all available information. Weak form includes trends such as short interest, past prices, and trading volume. Semi-strong form states that any prospects a firm has is already included in its stock price. And finally, strong form includes all information in weak form and semi-strong form, but also includes any insider information as well. All three of these hypotheses center on the premise that stocks are overwhelmingly set at fair prices. Ultimately, the efficient market hypothesis is proven to be true because it is a self-fulfilling prophecy. Once any new information is introduced to the market, the price is immediately reflective of that information. For example, if information is introduced that a stock's price will soar in the coming week, investors will immediately begin to flock to that stock and cause an immediate price increase. Likewise, if the stock was predicted to fall, there would be massive unloading of that stock. Therefore, what was predicted for the future would become today's reality due to investors' behavior. With this constant fluctuation, future stock prices are extremely difficult to predict with any level of certainty. One of the barriers to the vitality of an efficient market is the increasing proliferation of unethical trading practices. Because of notorious cases such as Martha Stewart, who used inside information for unfair gains, The securities market has become far more regulated than in the past. However, there is still much debate regarding the extent to which individuals and firms can gather and use information. Regulators are still working towards clearly defining these boundaries. Despite the vast evidence supporting the efficient market hypothesis, as with all things in the stock market, there is no absolute certainty. Critics argue that with enough analysis and know-how that the system can be beaten, and to an extremely small extent, they would be correct. As previously stated, firms are known to hire highly priced analysts to get a competitive edge. Because of the competition, it is unlikely that analysts will discover any information that will yield exponentially higher returns. However, because larger firms are able to invest more hefty sums of money, even a 0.1% increase on a $1 billion investment would yield an extra $1 million for the firm's profit. So this would justify hiring an analyst for the firm. However, for everyday investors who might have, say, $5,000 to invest, a 0.1% increase for that investor would only yield an extra $5. So it's hardly anything to get excited about. So this is called the magnitude issue. So yes, proper analysis can yield higher returns, but for the majority of investors, this issue is pretty irrelevant. Another argument of critics is that every now and then someone does discover a novel investment scheme that works. This is called the selection bias issue. The problem with this theory is that if it does occur, the finder would just take the information and run with it and make a personal fortune. Therefore, the general public would never even know that an anomaly occurred. Finally, a favorite argument of critics is, you guessed it, sometimes you just get lucky. This is called the lucky event issue. Chances are your friend Mike didn't end up with that beachfront property because of some grand investment scheme that he devised. He probably just got lucky with the stock that he or his broker chose. Look around your inner circle. How many of your friends have been able to get rich quick because of a stock tip? Chances are not many. We hear about stories like Mike's because that is the dream that everyone wants for themselves. We also hear about the precautionary tales of big flops to avoid. However, as previously stated, these are not the norm. Overall, the stock market has proven to be very efficient with minimal anomalies. Generally, in order to be successful in the stock market, a savvy investor should not go after the get-rich-quick scheme because they are almost always too good to be true. Instead, establish a solid portfolio, diversified to mitigate risk, and allow your money to grow over time. Various strategies for diversification will be presented in future sessions. So I certainly hope that you have gained some valuable information today to aid in your financial journey. I look forward to our next session together.